G'day there. Look, this is the first of a whole series of little video casts showing you about share investments. So we're going to go through a bit today, and then there's going to be sections that they'll have homework to do after each section. So let's have a look at this bit. This is the introduction bit. This course, as you know, has all segments in it which have to be assessed. All these bits here are accessible in the exam. We need to cover the whole lot in the tests, so we'll do that. And then these things will be covered as we go along. The first part of the course, we kind of break it into two bits, are all the bits in red, and as you can see the second part is quite short. Now we're going to look at the purpose of the share market. There's kind of two parts of it. One's called the primary market. The primary market is where you can raise money or raise as capital for a company. So you've got a company and you want to get some cash in. You can either borrow it from the bank, which would be quite expensive, especially if you wanted a few $1 million, or you can float the company on the share market. So you have to issue a prospectus, which is basically the roadmap about what you have to do, and have a broker that underwrites what you're doing, and then investors subscribe for shares. So you actually fill out some forms, send them in, and they subscribe for shares. So when they're released, these people get them first. So if you've got a company and they want to raise, say, $5 million, they will have to float 20 million shares at 25 cents each. So if they sell the whole lot of them, they get their $5 million. There's no interest on it, and they get their company floated on the market. Then the investors can remain as the shareholders once the thing's been floated, or they can trade them on the secondary market. Now the secondary market is where most people will do their buying and selling of shares. This is where you buy and sell shares in a whole lot of different companies to make, the general idea is to make a profit out of it. So it's kind of like an auction, it's kind of like eBay. So what you do is you have an idea of how much you want to pay for some shares, so you can enter them in via a computer system called Seats, and then what happens is when that bid is matched, the shares are transferred across to your name. Some people will go through a stockbroker, other people will just go online and buy them that way. A stockbroker can do like buy shares on your behalf and sell shares on your behalf. They have to meet a whole lot of criteria from the Australian Stock Exchange. ASX is the Australian Stock Exchange, and they've got to meet that criteria to become a broker. They buy and sell shares for clients and charge a fee. You can buy via the internet, and that charges a fee as well. Stockbrokers can also give you advice and act as underwriter for new shares. So if you're getting advice from a stockbroker, their fee will be a bit more expensive than if they're just buying and selling shares on your behalf. Not every public company can be listed on the share market. Okay, so you just can't go out and stick a company on the share market, sell some shares, and hopefully it all works out well. You've got to fit a whole lot of criteria that the Australian Stock Exchange sets out for you. You need to have a sufficient size. You need to have at least 500 shareholders. Have a capital of $1 million, which means you've got to have $1 million up your sleeve before you start. Have half-yearly reports, and be run by a board of directors. Okay, so those board of directors then run the business for you. So advantages of listing a company is like this. You can get money or funds relatively easily to fund your company or your direction that you're going in. Investors are attracted to well-performing companies, and you can keep key staff on by offering them share incentives rather than giving them cash payouts. The disadvantage of becoming a public company is that the existing ownership is diluted, because instead of you running the shop, or you and a series of partners running the whole thing, suddenly you have a whole lot of other people who are shareholders, which means they own part of your company, and so therefore they need a say in your company. So they can vote on certain issues, and they can go to the annual general meetings and ask questions, and you've got to be able to clarify them. And the directors are accountable to the shareholders. Okay, so suddenly the directors of the board, on the board of directors, are accountable to the shareholders, and there's a whole lot of information that's got to be disclosed if you're on a board, and there's increased costs with doing this. So there's listing fees, broker fees, and things like that. So that's a bit of a disadvantage. But if you kind of weigh it up with getting that money to be able to get that capital, so you can actually start your company and develop and expand, then maybe it's not a bad thing. So why should you trade on the share market? It can bring good returns. You can get a thing called a capital gain. A capital gain is when you buy shares and then sell them again and make a profit. So that's pretty cool, but you don't own the shares. You bought them, you sell them, so you don't own them anymore, but you've got a capital gain out of it. That's pretty cool. The other thing is dividends. Dividends is a division of the profit. Now remember that if you're a shareholder, you're a part owner. So for any profit they have, you should actually get part of it. And that's called dividend. They divide it up amongst all the shareholders. These are normally paid 6 months or 12 monthly. And what happens is you get an income from the shares. So you can invest in a company, and then after a while, you get some shares, so dividends sent to you, and that is just some money that you get for actually not doing anything except for the fact that you've invested in the company. So some people will build up a portfolio of shares. A portfolio is just a gathering of shares that can bring in a regular income. So they pay dividends regularly, so you get this income coming from there. As well as having a steady capital gain, which means that when you sell them off, you make a profit as well. So that's quite good. The other thing you need to think about is diversified investment. Diversified investments means that you put money in different areas, in different sectors on the share market. So one might be in banking, one might be in mining and oil, one might be in transport, one might be in retail, one might be in entertainment, and those things. And so therefore you're actually spreading your money across different sectors, which means that if one sector goes down, another sector might be going up. So it can actually help you to offset any losses that have happened over the short term. The other thing to remember with share market is long-term investment is generally better than short-term. Okay, long-term. So they're talking 10, 15 years. With the market crashing after the global financial crisis, it's going to take quite a while for that to get up and past where it was before. But it will eventually, and that's where the long-term investment comes in. So let's have a look at this graph. This is BHP over 10 years. So you can see it starts down here at around about the $10 mark and ends up at the $45 mark. Okay, so over 10 years, that's a very, very good return on your money. Now, if you watch it as it goes through, there's some peaks and troughs. It goes high here and drops back down again. Here we have the global financial crisis hitting us in here, and then we're returning back up slowly up to here. So you can see that over a long term, this works quite well for you. You've always got to think long term rather than short term, and you've got to have the big picture, like a long-term look at things before you make decisions. Have a look at Globe International. Globe is like, I suppose like Billabong. They sell surfwear and streetwear and things like that. This is a really short snapshot. This is April to March, so it's about a year. Now you can see they're going up and down, and it looks like, oh, it's pretty good. It's 40 cents there. Comes up to about 75 cents. That's not too bad, and stopping at about 50 cents. So you actually, if you held your money for that year, you would have made some money. So you might think that's pretty sweet. That's really good. Maybe I'll invest in that. That's because it's 1 year. Now let's have a look at Globe over a long period of time. Here we go. This year that we just looked at is here, so it doesn't fluctuate very much. And look at it up here. It comes up to here. So it goes quite high before it plummets right down low here. So people who bought it in here would have been quite happy when it got to around about here, but then when it suddenly drops down, then you're gone. Now you can see here, as it's dropping, people are trying to get rid of shares. This is telling you the volume of the shares, okay? How many people are getting rid of them or buying them, okay? That's just your volume of your trades. So here, as it starts going up, more and more people are buying it, hoping that it's going to bounce back up again, okay? As you can see it dribbling off down here, the volume of shares traded just kind of diminishes as time goes on. What you now need to do is in your homework notes, on pages 1 to 4, there's a whole lot of points about the market, about the types of shares, why investing in the market, and indicators and things like that, that you need to note. So you need to be able to recall the key information in there because you'll use it in projects and you'll use it in class discussion and you'll also use it in tests. So that's your first job. Cool.